When you're looking to invest in a stock, there are two ways to evaluate it. One is with fundamental analysis, and the other is with technical analysis. I'm going to show you the difference between the two and how to combine the idea of technical and fundamental analysis in your investing strategy. Fundamental analysis uses the financial statements reported by the business to calculate the intrinsic value of the business. An intrinsic value is what the company is calculated to be worth today. It's a calculation, so the intrinsic value will be different for everyone depending on how they set up their financial models and numbers. Remember, the intrinsic value has nothing to do with the stock price, so it does not take the price of the stock into consideration in its calculation. Technical analysis looks at the stock chart to analyze the long-term and short-term trend of the stock to determine where the stock price is most likely going to move to. The movement of the stock is based on supply and demand, which is driven by the emotions of greed and fear. In technical analysis, you're not going to be looking at anything related to financial statements, and you're just going to be looking at the stock chart and indicators. A lot of investors use both technical and fundamental analysis in their stock investment in order to buy into a stock when it's first undervalued and second on an uptrend. And in the long term, the stock price will move towards the intrinsic value of the company that we calculated through fundamental analysis. However, in the short term, the price movement is very volatile and driven by emotions and analyzed through technical analysis. By the way, I made a 4-step guide on how to evaluate and find stocks that has a durable competitive advantage for long-term investment purposes. Also, if you haven't subscribed yet, hit the subscribe button and the bell so you'll be notified every time I post a new video about investing. The intrinsic value of the business can change every quarter when the financial data is released. For fundamentally good stocks, the intrinsic value of the business increases in the long term because the business is growing. You also want to look at the 10-year stock chart to make sure that the stock price is indeed on a long-term uptrend. For example, if we look at the long-term stock chart for Facebook, you can see that it's on a clear uptrend. However, when we look at American Airlines, you can't see an uptrend. So if we bought and held American Airlines stock from 2014, we would have actually lost money. Again, that is why it's so important to buy fundamentally good companies for long-term investing. In the short term, the movement of the stock price is volatile and you cannot predict where the stock price will move to. When you're investing into a stock, you want to buy it when the stock price is at or below the intrinsic value of the business and moving back up after a retracement. Because even when the stock price is below the intrinsic value of the business, if the stock is on a downtrend, in the short term, cheap can get cheaper. That is why you want to wait until the stock moves back up from a retracement. This is how people combine fundamental and technical analysis together for stock investing. Now let's look into an example. This line right here is the intrinsic value of a fundamentally good business in the long term. Because for fundamentally good businesses, the intrinsic value will be growing. If we calculated the intrinsic value of a company is $50 and right now the stock price is $60, then it's best to wait until the stock price is $50 or below before we buy into it. If the stock price is $40 right now and the stock price is still dropping, then you want to wait until the stock is moving back up before buying into the stock. So this right here would be your sweet spot for buying into a stock for long-term investing. This $50 intrinsic value won't remain the same and can go up or down depending on the reported quarterly financial statements. Remember, this is for stock investing, not trading. If we're just trading stocks to take short-term profit, then the intrinsic value doesn't matter because expensive can get more expensive and cheap can get cheaper in the short term. For short-term stock trading, you would only be using technical analysis and only be looking at the stock chart. For more videos, check out the playlist on stock investing for beginners and stock investing terminologies.